and if you can introduce yourselves, that'd be great.
Sure.
Hey everyone, we are here with Jason and Arthur. They'll be doing a fireside chat on value accrual on DeFi tokens. Once they start talking, can you confirm in the chat that you can hear them, and they'll be introducing themselves.
I think we can get started. Hey everyone, this is Jason right here. I'm not sure if you guys can hear me yet. I'm just going to wait for confirmation before we continue on with the intros.
Okay,
Awesome.
perfect.
All right, Arthur, why don't you go first in terms of introductions?
Hi everyone, this is Arthur. I'm the founder of Defiance Capital. Defiance Capital is a DeFi-focused crypto asset fund based out of Singapore. We are one of the earliest investor to really focus on DeFi in the space. Yeah.
Awesome. And I'm Jason. I'm the head of research at Spartan Capital. We are a crypto asset hedge fund, and we have a venture fund as well. And we focus a lot on DeFi, and we're based out here in Hong Kong. So yeah, super excited to do this. Arthur, I've obviously learned a lot from you over the past year of kind of investing in DeFi, and I'm really curious to kind of jump into this fireside chat just because of all the craziness that's been happening in DeFi. And I think this chat would be helpful for not just investors or speculators who are looking into DeFi tokens, but also founders when they think about how do we build tokens that capture value and incentivize their users. So I guess before we were recording, we were talking about governance tokens, and we see all these new yield farms launching their own governance tokens that kind of confuse a lot of people because people don't seem to know how it captures value. So I'm curious about, just from a high level, what are your thoughts about the current state of DeFi in terms of all these governance tokens? Are these all just, a huge casino, or is there actual value to be captured here?
I think the situation is pretty nuanced. I think it need to be judged on a case by case basis. So I think a lot of the DeFi project have put a lot of thoughts into this and like how the token is gonna capture the value. But I think when it comes to all these food token, it seems to be an afterthought for a lot of them, or a lot of them are actually more similar to like a commodity money. Like, for example, I think a lot of the new food token, they are heavily inspired by Ampleforth. And Ampleforth itself, it doesn't really capture any value. It's like a commodity that is very volatile, targeting a certain price that by changing its supply. So I think in that sense, I think that the value capture is just that you hope that it can become a very like a commodity money with a very significant value in the end. Yeah, so I think that one is a bit more different. But if the protocol is providing certain services, and they charge a fee for these services, and then that means that the protocol will have some fee that you'll be able to capture. So it ultimately depends on how are they going to distribute the fee. Is it through like a pretty standard buyback and burn model, or will there be some sort of fee reward that the token holder can receive it directly? Yeah. So so I think about this, right? What I actually identify a phenomenon, which is it seems like even for a lot of the very leading DeFi protocols, it seems that the market doesn't pay as much attention to this value capture compared to us. Actually, I mean because we have discussed this multiple times, so we have been beating about value accrual is very important. You must design your token in a very careful way. But it seems that a lot of DeFi protocol, they've just launched their token first with just a very simple on-chain governance function, and the market still give them a very warm reception in terms of token price and how they perceive it. What do you think about this? It seems that a lot of some of the professional investors care a lot about this value accrual, but it seems that the wider market sometimes are more willing to give them a bit of a free pass on that one.
Yeah, no, I agree. I think in terms of value accrual, well, obviously most of the crypto is still traded heavily by retails, and I don't think there's a lot of kind of sophisticated valuation methodology still going on. And I agree that a lot of the projects are probably prioritizing growth right now, rather than just straight up fee capture. And we saw this play out with the Terra project. And for those who are not aware, it's a stablecoin project primarily with a user base based in Korea. And initially, the idea is that for the transactions on the stablecoin network, it would generate a fee and it would pay out a dividend to holders of the Luna token on the network. But what the project found out in the early days is that there's simply not enough users in the very early days to generate a meaningful fee. So using that narrative that this token is a capital asset that accrues dividend actually hurt them. So they had to retroactively introduce an artificial inflation just to jack up the rewards in the early days to bootstrap the users. So I think for people who are designing tokens out there, figuring out how to capture value is really important. It's almost the same as kind of figuring out how do you monetize a startup. But the same with a lot of startups out there, you probably don't want to be focusing primarily on monetization on day one. You want to be focusing on user growth, on incentives on day one. And I think one of the telltale signs for me is the reception that the market has been giving for Compound and Uniswap, because neither of these tokens capture fees, to my knowledge, currently. But there's an expectation that by giving governance, they will capture fees in the future. So do you think that's like a valid way to think about these tokens? Can founders just launch a governance token and basically expect the market to vote for the token to capture some fees in the future? Should that be kind of the de facto way that most of these tokens should be designed?
Yeah, I think initially I was surprised by the market reaction to this because Compound, the token itself, did very well on the first day of listing and without any other value accrual. It's just a simple governance token. So it seems like the market think that it doesn't matter. So I think over the time, I've learned to change it. I've learned to accept that this is a pretty viable method. I think like sometimes the community might have a very helpful contribution on how the token can design in a way to capture value. So yeah, I'm less adamant as I compared to what I used to on having a good value accrual mechanism straight out of the gate for this DeFi token. Yeah. So yeah, and I think what's your thought about a good value accrual or like a good token design? So I'll start with my opinion. So I think that there's two major principle I would follow when designing a good token, especially when it comes to DeFi crypto. I think first is I think one of the unique thing about crypto is it gives us the liberty to experiment with a lot of things. So I think this opportunity should not go wasted. So I think one of the good principle to follow is the token should incentivize the growth of the network, because if you can't achieve that, you might as well just do it like a standard traditional company structure. You don't need to have token to give you additional burden. The second thing is it should capture some value so that the token holder are getting something when they are like contributing their time, even their capital into the protocol itself. So, and the specific value accrual mechanism, I think there's still a lot more innovation we can do on this. But I think that right now in the market, buyback and burn is a pretty standard model. And another model, I think Maker is probably the most popular for doing that in the DeFi protocol. Like they will burn their supply with some of the fee that's captured. Another way is to use as a direct fee distribution. This is what synthetics have done. If you are part of the synthetic SNX staker, the native token staker, you will get part of the fee reward distributed by the protocol every week. And the fee reward comes from both the inflationary reward and also the trading fee captured by the protocol itself. So that's one way. And like another way, I think it's also a pretty good design. Kyber network. So Kyber have an on-chain governance module, and they only distribute the fee to the token holder if they participate in the governance process. They have to at least vote once a week. Yeah, so I think this is some of the more like the standard direct value capture mechanism. So yeah, I think if you follow these two principles and innovate around these two, I would consider that to be a pretty good token design. But what about you? What do you think? Do you think I missed anything? Like anything else you'd like to add?
Yeah, no, I think that's a great way to put it. I think it really just comes down to those two things, right? Because initially, when I was looking at a lot of tokens when I first started being an analyst in the spaces, I thought, wow, a lot of these seem like Ponzi schemes, right? There's no value accrual. People are just kind of playing on the greater fool theory. But for some reason, people are still buying some of these tokens. And then I started noticing that the reason why I got excited about DeFi in the first place is because it's the only vertical where there's meaningful fees being generated, right? And to the tunes of millions. I think I saw someone put out an analysis yesterday about how all the lending protocols currently are paying out almost $70 million in interest aggregated across all of the lending protocols in a year. So there's actual meaningful fees that are generated on DeFi, and they can be used to be distributed to token holders. So that's when I realized, okay, these tokens are actually more similar to equities than I thought, because you can get paid out a dividend by staking, as you mentioned, on networks like Hyber. You can get basically a buyback for a lot of these buy and burn models. But then the second part that I wasn't thinking as much about, which makes a lot of sense, is the incentive part. Because if you're just going to launch a token that entitles users to a fee, then you should just launch a company structure and have equity, right? Whereas tokens are a powerful way to incentivize specific behaviors that you want out of users. So I think Andre Kondry, who is the creator of the Y-Earn protocol, put out this article 2 days ago about how tokens are not supposed to be equity. And this echoes a lot of the sentiment that we heard back in 2017 from different funds that were basically critiquing the state of tokens and how a lot of them are just commodity money and not really equity. And they're not equity, but they're kind of tokenized incentives, right? So they're basically a type of almost reward points for users to be rewarded with once they do certain types of action. But the difference here is some of these reward points also actually have a fundamental value that you can model out, because some of them entitle you to fees. So I do think that it's not an either or thing. You have to, first of all, introduce the right type of incentives with the tokens. And number two, you have to imbue the token with value by entitling it to some sort of value capture. You can't just introduce a utility token and say that, oh, this is going to be the transactional currency for my platform, because then you're just counting on the token to become some form of money. So going back to your initial point at the beginning of this chat, I think that's more kind of up in the air. I think, to me, I'm less convinced about the value of things that don't really have a quantifiable value capture, because you're basically directly competing with other forms of currencies. So that works for something like Bitcoin, where you have a massive history and meme around it. But for most of the new utility tokens, I don't see a lot of future there. And I like to kind of talk about the value accrual mechanisms as well, because you mentioned the buy and burn model. But obviously, there's a lot of different other types of models as well. And before we were recording this, you mentioned this article written by, I think, Chris Berniski from Placeholder about a buy and burn. So maybe we can touch on that a little bit too.
Sure. Yeah. It's actually I just checked. It's actually written by another partner, Joel Monegro. It's the topic is called buy back and make instead. And I think that this is a thought pieces I very much agree with, because I've always been thinking about this. Like, I think buyback and burn model is a very simple and lazy way of designing a token. Yes, I mean it does have some value accrual, but I think it's almost in all scenario is a suboptimal, because when you if you have studied corporate finance, you know that a company should buy back its stocks when it think that it cannot generate a better return by investing in it. Yeah. So this cash flow, there's a few ways you can reinvest to grow the company, or you can use it to buy back the stocks and keep it in the treasury. And actually, and there's also one distinction. I think it's also mentioned in the article that when when the company buy back the stocks, it's actually not really burned. They keep it in the treasury, and they can actually use it in the future. I mean, they can use it as like an employee incentive, all this thing. But most of the time, it is actually just like sitting dormant in the company's treasury account. So, and I think that in this process, especially for a DeFi protocol that is at most of them are at a growth stage, this actually destroy pretty valuable capital. Yeah, because when you accrue some sort of fee and you use it to buy the token from the market, you kind of decrease the market capitalization and also destroy the capital you have. And I mean, if you believe that the market is 100% efficient, the market capitalization should stay the same. But it's not what we have seen in the market so far. I mean, the market price doesn't really directly adjust the burning of the supply. I mean, we have seen this happen. I mean, Stella burned more than half of their supply, but I mean, the price did not really double because of this as well. So I think that so that's why I think that I agree with this article a lot, that the buyback and burn model is actually in most situations is actually suboptimal. And you might also create a situation where the DeFi protocol is actually, let's say this DeFi protocol is overvalued right now. And by using the buyback and burn model, it's actually overpaying for its own protocol. Yeah, because I mean, you can't unless you are like trying to time the market in your buyback and burn model. Else, there is some time that you end up overpaying for the protocol. So I think there was some analysis done on this on the Maker token, and I think in almost a lot of situations it's really suboptimal. Yeah, so I think instead that like the buyback and make model, use those fee generated to incentivize the growth of the protocol, like paying out to some of the core community contributor that really like to contribute more, but probably currently can't do it because they have a full-time job, and just try to grow it from a more holistic perspective. I think this is in almost all the situations are better than like a buyback and burn model. Yeah. I think for those of you who are more interested, yeah, you can go and read it. It's listed on the placeholder VC website.
Yeah, I hear you on that. And I think one main point of frustration for me is that I think a lot of the recent DeFi projects, so I've looked at almost, probably over 100 projects this month. And a lot of these projects basically default to buy and burn as some sort of a fee capture model. And I think this is, as you said, popularized by MakerDAO, and it's worked quite well for them in terms of starting this meme around burns. And I think where we see it being most popular is exchange tokens. Basically, you see Binance launching their own token and dedicating, I think, 20% of the profits to a quarterly burn, and all of the exchanges basically followed suit. So that's actually something that I never really understood, why they decided to go with that rather than pay out a dividend or maybe lock that capital up in some sort of a treasury investing. So my understanding is probably for something like Binance or OKX or Huobi, which are relatively more mature exchanges, there's not a huge need for 20% of profit locked in treasury. But then for DeFi protocols, it definitely doesn't make sense for everyone to just kind of default to buy and burn, especially if you're early stage protocol is trying to bootstrap liquidity. So that's why I was kind of fond of the model for YEarn, because they basically they create these robo-advisor strategies for users, so you can put in capital and generate a yield across all of these DeFi protocols, and part of that interest is collected as a fee, and then put that fee into a contract, which is used to pay for the development of the protocol. So I think that just goes to show that because you're developing some sort of a token for a platform that's generating fees doesn't mean that you have to default to a buy and burn model. There are more creative ways of doing that. So yeah. I'm quite fond of that.
Yeah, and I think one thing very interesting is I think actually we are the entire crypto space. We are also in a slow transition process, and I think that most of us might not realize it. But when you take a step back, that's what I have realized. I think for most of the history of cryptocurrency, I mean, the most popular term to describe it is still cryptocurrency. And I actually think for most of these assets, most of this crypto, I think a better term to describe them would be crypto asset. So I think that this is also a transition phase, because most of the old crypto, they are like Zcash and Monero and all this. They are really similar to commodity money. They are all inspired by Bitcoin. So there's really no value accrual to talk about, because they are all commodity money. And I think but actually when you look at the real world, the real financial market, capital asset that produce cash flow is I think at least an order of magnitude bigger than like a pure commodity money store value asset, which is mostly gold in these cases. And in almost all other capital assets, I mean, equity is a capital asset, bond is a capital asset, and even I think real estate arguably is a capital asset because all three of them produce cash flow and they are all worth of like trillions, tens of trillions in market cap combined compared to gold, which is like just 4 trillion in market cap. And if you look at all the major asset allocation, most of their assets are allocated to this capital asset. But in crypto, because of we are started by Bitcoin, I mean, everyone just like think of crypto as like a commodity asset where you just, non-sovereign store of value and gold, instead of like a capital asset where you can actually have a cash flow that you can measure and some sort of value accrual that is, I think in a way that for a lot of traditional investor, this is actually way more attractive than like a pure digital gold. Because I mean, this digital gold narrative has been discussed and talked about many times. And I think that almost anyone on earth that really buy into this digital gold narrative have heard about it and kind of either make some allocation or, are really ready to take the leap of faith already. But I think when it comes to capital asset, I think very little traditional investor think that you can actually invest in crypto just like how you invest like a traditional stock market as like in allocating to productive asset. I think this is something that we're in a transition process and not many people have realized it yet. Yeah, and obviously that we have this it's a bit more, I think there's some differences in the details because in a traditional asset, a lot of these assets will be considered a security. So I'm not a lawyer, so I think that, and I think every country have a slightly different definition of what constitutes a security, and especially when it comes to Singapore, the definition is slightly different, I would say, compared to the US. And I think a main reason that a lot of these exchange token they don't really want to use like a direct fee distribution model is because they do not want to be perceived as a security. But I think that is actually just like a more of a form factor. I think that if I don't think it make a difference whether you are like a buyback and burn or you are distributing as a fee. I think if the regulator think that you are security, I don't think this two factor alone is going to change their mind. So I think it's just like a self assurance kind of thing that I don't think it really makes sense. Yeah. It just actually doesn't really work. Yeah. So I think that's just my view right now. Yeah.
Yeah, that makes a lot of sense. Yeah, I think regulation front is a huge point. I think a lot of people, I think back in 2017 when I was looking at a lot of the tokens, and I thought, okay, most of these are kind of, there's no clear value accrual, and there's an article that I read back then by, I think, a fund called Tetris Capital, and they said tokens are not equity, and they basically critiqued how all of these utility tokens are just, like you said, kind of just random commodities. They don't really have clear ties to the performance of the underlying network. So if there's a lot of user growth on something like the Brave browser, for instance, it might not necessarily tie into the growth of the BAT token, which is the token they use to reward users on the platform. And in recent years, we start to see more equity-like tokens, but then I think a lot of founders try to not paint their tokens in that light because they don't want to incur the wrath of regulators. So I personally have some thoughts on that. Again, neither of us lawyers here, but then I think there might be some, disagreements between what is a common enterprise, what does it mean to rely on the work of others, if the network is maintained by a decentralized community of nodes rather than just one company. So I do think that once we get more clarity from regulators, we'll see kind of more kind of clear-cut token model designs. And kind of going back to your point about commodities versus capital assets, there's this great article by Spencer Bogart from Blockchain Capital about how crypto is almost like a platypus where you have a combination of different factors. So I'll be curious to get your thoughts on this because a lot of people have been kind of depicting Ethereum as a type of commodity, but then with the impending launch of something like EIP 1559, which basically burns a part of the gas fees used on the network, which kind of resembles a buyback and retirement scheme for stocks. What do you think about that? Do you think that we're going to see things like that, like a hybrid model being more popular in tokens? And how do you think that's going to play out?
I think that this one will have, again, I think there's a lot of things to unpack here. I think for Ethereum specifically, it's definitely a good design, because I think up until right now, there is no direct way to link the performance of and the usage of Ethereum network into the Ether token itself. I mean, is right now is on the same category compare to Bitcoin. I mean, it's just like a simple like a commodity money. And I think that the community has been really wanting to link the usage, because I think right now Ethereum is suffering from like I think it's more like an impression reason that most of the crypto investor think that is like the monetary supply is like the monetary policy is not as rigid as Bitcoin, therefore making it a less good of a money. Yeah. So I think that and Ethereum, the whole entire philosophy is always like we are more on a trying to build better applications, and Ethereum is just a good collateral inside the network. And when Ethereum transit to a proof of stake, it will just become like a native asset you need to stake to participate in the consensus protocol of the network. But I think even in that sense, it's people just find it very disappointing that you can't link the increasing usage of Ethereum with the price of and the value of the token itself. So I think this EIP 1559 partially is to alleviate the gas issue, to make the gas price much more predictable. And another reason is just to have a more direct link between the supply and demand for the Ether token and with the usage of the network itself. So I think this is a pretty good way. I think in that way, it still make Ether more like a commodity money. It's just that you have like EIP 1559 serve as like a demand thing. It's just that if you're talking about most commodity, there's a supply which is extracted out from earth, and the demand is actually consumed. So the commodity is actually consumed away, and it's not recycled back into the market in such a direct way, especially let's say for crude oil. But when you talk about Ether, without EIP 1559 in place, all these fees are going back to the miners, and the miners are selling back into the market. So there's no actual demand sink for that. So even if like the demand for Ether increase a lot, as long as the miner just sell them back into the market, the net effect is actually very low. Yeah. So I think the ICO is a little bit different because people are acquiring ETH to participate in ICO. But right now, if this phenomenon is removed, there's really no direct link because the miners can always sell their Ether back in the market.
Yeah, no, I agree with that. And I think we're actually just coming up on time soon. So I guess just to wrap up, I think what might be helpful is for us to kind of, from the perspective of investors who looked at a lot of these projects, to kind of give advice to, I guess, new founders who are building these new DeFi protocols, and they're thinking about, okay, how do I create a token that's gonna capture value correctly and also incentivize usage? So I don't know if you want to go first in terms of just general advice you have for founders designing new tokens. Like, what are the main priorities they should be thinking about? What are some resources they could use?
Yeah, I think the first resources is to look at a successful protocol right now. I mean, especially those that people talk about them having a good token design. Study them, study what make them so successful, and then I think there's a lot of article in the space right now talking about value accrual and how to design a good token. Obviously, go and study those as well. I think there's no shortcut on this, and I talk about the two principles. One is it should incentivize the growth of your protocol. The second thing is there should be some ownership and a link between the performance of the protocol and the value of the protocol. So I think as long as you follow these two principles, I think you're already in a very good start. Yep.
Yeah, and I echo that by saying definitely don't fall for the commodity money meme. Don't fall for the meme that just because you create a token, people will come to use the platform. Just because you pay users the token, they'll be incentivized to use. Over the long term, there needs to be a way for the token to capture value. So the short term, you could create maybe memes around it, narratives around it, have the price perform really well in the market and give the illusion that the token is capturing value. But in the long term, if you do want this to be a self-sustaining, decentralized model, be it a DAO or some sort of decentralized network, there needs to be a very clear value capture model. And the few ways that I think we discussed today, beyond just buy and burn, are staking and actually paying out a dividend, or even more novel models like Nexus Mutual, which ties the kind of price of the token to the growth of the underlying capital pool. So it all goes back to kind of looking at some of the most successful cases. And I think in terms of success, define it not just by the token price performance, but more in terms of the actual usage, right? So you can use things like Dune Analytics to track the usage of these platforms. So yeah, there are a lot of resources that people can refer to, and you can reach out to, I think, either of us on Twitter. We're very active there. We're always sharing a lot of these resources.
Yep.
Yeah, this is fantastic. Thank you guys so much for taking the time. We're going to transition to our next session now. And again, thank you. This was great.
Thanks, everyone.
Thank you, guys. Yep.